Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into NextEra Energy, ticker NEE.
Yeah, NEE. It's more than just your average utility these days. It's really a global energy powerhouse. And I think diving into it now is, well, it's pretty crucial.
Why now specifically?
Because NextEra's strategy, it's like the clearest roadmap we've got right now for how these huge energy infrastructure companies are planning to tackle this massive surge in power demand driven by AI. It's happening fast.
That's a great point. So our mission today, let's be specific. We want to unpack NextEra's structure, which is kind of complex, right? Two-part.
The dual engine thing, yeah.
Exactly. We'll look at their financials, strong numbers as of Q3 2025, and then really zero in on this high-stakes plan they have to meet that soaring demand, specifically that big nuclear deal they struck with Google.
That's the really interesting part.
Right. We're framing NEE as, well, probably America's top energy infrastructure developer. They're navigating what their own execs are calling a golden age of power demand.
And it's not just AI, though. That's huge. It's also reshoring, manufacturing coming back, plus electrification of everything, cars, industry.
It all needs power, lots of it.
And when you look at NEE, you're really looking at a company trying to balance two worlds. On one hand, you've got the super conservative, regulated, stable utility side.
Predictable.
Very predictable. And on the other, you've got this almost like a venture capital arm, but for massive infrastructure, super aggressive development.
Okay, so understanding how those two engines, as they call them, work together, that's key to getting the risks and the opportunities here.
Absolutely. It's the only way to really grasp what they're doing.
Yeah.
#2, dual engine model and financial stability breakdown.
Okay, let's start with that foundation then, the dual engine model. Why is this structure so important for NextEra? How does it let them operate at such scale?
Well, it's fundamentally about managing risk. They've got these two core segments, both world-class in their own right, but with really distinct revenue streams and different risk profiles.
Okay, let's break it down. Engine 1, FPL, that's the bedrock, right?
It's FPL, Florida Power Light Company. This is your classic regulated utility. Operates across Florida, which is, it's a massive growth market in itself.
It's this growing state, right?
Often cited as the fastest growing state, yeah. And its economy, if Florida was its own country, it'd be something like the 16th largest in the world.
Yeah.
So you got this constant influx of people, businesses. It guarantees steady customer growth for FPL.
And being regulated means income is pretty predictable. Seems like the perfect balance to, risky big bills.
Exactly. That's the whole point.
Yeah.
FPL's revenue comes mainly from tariff-based sales. So selling electricity to homes and businesses based on rates approved by regulators. And that predictable revenue. It makes up something like 90% of FPL's total operating revenues. Utilities basically get a monopoly in their area, but in return, their profits are capped, regulated. So this part of NextEra provides incredibly low-risk, steady, stable cash flow. It's the financial bedrock for everything else NE does.
The anchor.
The safe, reliable anchor, precisely.
And the numbers show FPL isn't just sitting still. It's growing pretty aggressively within Florida. What that Q3 2025 show, and what's the plan going forward?
Yeah, the growth is solid.
Yeah.
FPR customer accounts, they grew 1.6% year over year in Q3 and 1.7% for the first 9 months of 2025. Now, that might not sound like a huge percentage.
But for utility that size.
It's fantastic. Reliable, compounding growth. But maybe more important is the investment. FPL is just a massive capital investment engine. They plan to pour about $40 billion into new energy infrastructure just within Florida over the next 4 years.
$40 billion? That's a staggering amount for just one state utility. What are they building with all that?
A lot of it is focused on modernization, making the grid stronger, more resilient, especially against storms, which is obviously a big deal in Florida.
Makes sense.
So the plan includes adding about 5.3 gigawatts of solar power generation, 3.4 gigawatts of battery storage, plus just general grid hardening. And the key thing here is, because it's regulated investment.
They know they'll get a return on it.
Exactly.
Yeah.
Those capital expenditures are pretty much guaranteed to generate a regulated rate of return. That gives them and investors real clarity on future earnings from FPL.
Okay, so that's the stable anchor.
Right.
Now, let's talk about the other engine, the high-growth side that gets a lot of attention globally. NextEra Energy Resources, or NEER.
Right, NEER. This is the counterweight. It's the unregulated development arm focused on clean energy. And honestly, it's probably the biggest pure-play renewables developer on the planet.
Wow.
Its whole model is geared towards high growth, big strategic projects, mostly outside Florida. Revenue here comes from long-term contracts, power purchase agreements, PPAs.
Yeah.
They sign these with big companies, other utilities.
And those PPAs are key, locking in revenue for years, right? Decades even.
They really are. These contracts often run way out, sometimes as far as 2055. So even though NEER operates in the unregulated market, which can be riskier, you're dealing with energy commodity prices, capacity markets, transmission issues. That revenue stream gets stabilized by these super long contracts.
So it's maybe high risk building it, but once it's built and contracted.
The revenue delivery is pretty certain, yeah. High certainty there.
And the scale of NEER. I mean, that backlog number they talk about, it's almost hard to wrap your head around.
It really drives home their dominance. NEER's got this massive renewables and storage backlog, projects planned but not yet built, of about 29.6 gigawatts.
Okay, put 29.6 gigawatts in perspective for us.
All right, think of it this way. 29.6 gigawatts is roughly the entire installed electricity generating capacity of a country like, say, the Netherlands, a significant industrial nation.
Okay, that's huge.
It is. And this backlog, this pipeline, is what lets NextEra capture that accelerating global demand for clean energy. It represents, potentially decades of high-quality growth ahead.
Okay, so let's put the two engines together now and look at the overall financial picture, especially as of Q3 2025. How healthy does NEE look when you combine FPL and NEER, especially with these enormous spending plans?
Well, the consolidated numbers show they're executing pretty well. They're translating that scale and that dual strategy into solid performance. For example, NEE delivered strong adjusted earnings per share, EPS, growth. It was up 9.7% year over year in Q3 2025.
Almost 10%.
Yeah, and 9.3% growth for the first 9 months of the year. Pretty strong. And this performance let management come out and explicitly say they expect to hit the top end of their adjusted EPS guidance ranges all the way through 2027.
Hitting the top end, that shows a lot of confidence. And usually that confidence translates to how they treat shareholders, especially with dividends, right? That's often a good signal.
It absolutely is. NEE has a stated goal, an expectation, to grow its dividend per share by about 10% annually, at least through 2026.
10% dividend growth is pretty premium for a utility.
It's definitely top tier in the sector. And it's all supported, really underwritten, by those predictable, steady cash flows coming out of FPL. FPL's cash flow is basically funding that premium growth expectation.
Now, the spending, let's talk CapEx, because the numbers are just monumental. How does this stack up against others in the industry?
It really cements their position.
Yeah.
Not just as a utility, but as the premier energy infrastructure developer in the U.S., arguably. Their total capital spending CapEx, plus independent power projects, nuclear fuel purchases, just for the first 9 months of 2025 was $19.3 billion.
$19 billion in 9 months.
Yeah. And if you look longer term, their projection through 2029, the total CapEx is, well, it's astronomical, $74.265 billion.
$74 billion over basically 5 years. Wow. How does that break down between FPL and NEER?
So FPL, the regulated side, accounts for the bigger chunk, about $42.96 billion. And NEER, the development arm, is projected at $31.305 billion. Spending that kind of money requires financial discipline that most companies just don't have.
Okay, deploying nearly $75 billion needs more than just good revenue. You need a rock-solid balance sheet, right? Access to cheap debt. How are their credit metrics looking? And why should, say, an average investor care about things like FFO debt ratios?
Oh, they're absolutely critical. The good news is their credit metrics are strong. They're staying on track with what the big rating agencies like S&P and Moody's want to see. That's what keeps their borrowing costs low.
What are those targets, roughly?
So, for instance, S&P looks at funds from operations to debt, FFO debt. NEE aims to keep that above 18%. Moody's looks at something similar. Cash flow from operations pre-working capital to debt, CFO pre-WC debt, and the target there is over 17%.
And hitting those targets isn't just about checking a box, right?
Not at all. It directly impacts their credit rating. Maintaining a strong rating means they can borrow money more cheaply to fund that entire $74 billion pipeline.
And if they slipped, if they got downgraded,
their borrowing costs would go up immediately. And when you're building massive long-term projects where your profit margins are measured in, fractions of percent over decades, even a small increase in interest costs could seriously hurt the profitability of a lot of those NEER projects.
So FPL's steady cash flow supporting those credit metrics, it's kind of the unsung hero of the whole growth story.
Absolutely. It's the financial engine making the whole thing possible.
Okay, here's where the story really takes a turn, right? From steady growth to something much more aggressive. All that massive spending is being aimed squarely at tackling this golden age of power demand you mentioned. Just how big is this demand surge, and why the urgency?
The catalyst is huge. It's this convergence of massive AI adoption, data centers popping up everywhere, and this broader push towards electrification.
Yeah.
NextEra's own forecast suggests overall U.S. energy demand could increase sixfold over the next 2 decades.
Sixfold. Wow.
Yeah, primarily driven by those factors. And data centers, especially the big ones running AI, the hyperscalers like Google, Amazon, Microsoft, they need absolutely enormous amounts of power. And crucially, it has to be continuous high-density power.
Continuous meaning 247 reliable, no interruption.
Exactly. You can't have fluctuations. For a data center, an outage isn't just lost revenue. It could mean corrupted data, massive problems. The cost is astronomical. They need base load power, power that's always there, always stable.
And no NEER saw this coming.
They definitely did. They've positioned themselves strategically, even before this big nuclear move. Their existing renewables portfolio operating assets, plus that huge backlog, already had 10.5 gigawatts specifically dedicated just to tech and data center customers. They identified this as a really lucrative customer segment early on.
Okay, but that leads to the fundamental problem, doesn't it? NEER is the world's biggest renewables developer. How do you guarantee 2047 baseload power with technologies like wind and solar, which are, intermittent? They don't work when the sun isn't shining or the wind isn't blowing.
That's the critical gap. That's the challenge. Battery storage is getting better, definitely. And NextEra is building a ton of it. But right now, batteries alone just can't reliably bridge, say, several cloudy, windless days for a massive AI cluster that needs hundreds of megawatts constantly.
So wind and solar, even with batteries, struggle with that zero-carbon, absolutely continuous baseload requirement.
But they still struggle to guarantee it at the scale and reliability needed. And that realization, that gap, is what really drove this strategic pivot towards the only currently scalable zero-carbon technology that can meet that kind of baseload demand.
Nuclear power.
Nuclear power.
Which brings us to, okay, this is where it gets really interesting, as you said. The landmark partnership with Google involving the Duane Arnold Energy Center, DAEC. This feels like a genuinely historic move in the infrastructure world.
It really is. DAEC, it's a single-unit boiling water reactor, BWR, out in Iowa. It ran for decades, but its story got dramatic back in August 2020.
The Derecho storm, right?
That massive Midwest Derecho storm hit it hard, specifically damaged the cooling towers beyond, well, what they thought was economical repair at the time. So they shut it down permanently. It was officially scheduled for decommissioning later that year. It was basically a dead asset, mothballed.
So NextEra is taking an asset that was literally written off, heading for the scrap heap, and resurrecting it specifically to power the AI boom.
That's the plan. That's the big bet. NextEra and Google teamed up on this plan to recommission the DAEC plant, which is rated at 615 megawatts. And it's moving fast. The formal regulatory process kicked off in January 2025.
And when do they expect it back online?
The target is Q1 2029, which, 4 years sounds like a while, but for turning around a nuclear plant like this, it actually shows a lot of urgency. It also reflects the huge amount of capital they need to pour into it.
Let's dig into the deal structure. That 25-year PPA with Google seems absolutely central to making this work financially for NEE.
It's the linchpin. That 25-year power purchase agreement locks in a predictable and likely high-margin revenue stream directly from Google. And critically, the way the deal is structured, Google is covering the investment needed for the restart.
So Iowa ratepayers aren't on the hook.
Correct. Iowa customers face no cost exposure from the restart itself. For NextEra, the projections are that this single project will add up to $0.16 to their annual adjusted EPS on average, just over its first 10 years.
16 cents per share from one deal. Given any scale, that's actually a pretty significant bump. High-quality earnings, too.
Very significant, yeah, especially from a single infrastructure play.
Now, there was a bit of financial maneuvering needed, wasn't there? DAEC wasn't fully owned by NextEra when it shut down. How did they get 100% control?
Right, it had minority owners. Central Iowa Power Cooperative, CIPCO, and Corn Belt Power Cooperative together owned 30%. NEE acquired those minority stakes.
How? Just buy them out.
Not with cash, which is the interesting part. It shows their financial savvy. NEE took over the cooperative's share of the future decommissioning liability for the plant in exchange for their ownership stakes.
Ah, so they took on a future cost obligation instead of paying cash now.
Exactly. And since NextEra already manages huge decommissioning funds for its other nuclear plants, they basically said, look, we have the scale and expertise to handle this liability efficiently. It's a win-win. They specifically noted they have more than ample decommissioning funds already.
Smart. So they use their existing financial scale in nuclear management to consolidate ownership of this high-potential restart project.
It was clever financial engineering. And the impact goes way beyond just this one plant. They're touting huge economic benefits for Iowa, over $9 billion projected, plus 400 direct full-time jobs in Linn County once it's running.
And strategically.
Strategically, this whole Google partnership is explicitly designed as a template, a model for future collaborations on potentially new, advanced nuclear projects across the country. It positions NextEra not just as a leader in renewables, but potentially in nuclear revitalization too. #TAG IV. Risks and competitive mode analysis.
Okay, but we have to talk risks. This is a massive bet, a high-stakes gamble, restarting a mothballed nuclear plant, especially one with history. NextEra is taking on some serious technical, regulatory, and, well, historical baggage here. Let's start with the risks tied specifically to the DAEC project itself.
Absolutely. And there are two big ones we really need to unpack: the regulatory and execution risk and the historical design risk. First, the regulatory side. This is hugely challenging because, quite simply, the U.S. has never successfully restarted a mothballed nuclear plant that had already formally entered the decommissioning process.
Never. There's no precedent.
No precedent. The rules, the regulations, they just weren't written with this scenario in mind.
So how are they trying to get around that, since the rules don't exist?
They're applying for an exemption. They're asking the Nuclear Regulatory Commission, the NRC, to basically grant them a waiver from the existing decommissioning rules.
An exemption. Why is that controversial?
Because critics, environmental groups, watchdog organizations, they argue very strongly that this is misusing the exemption process. Exemptions are usually meant for, unforeseen circumstances, things that create undue hardship if the rule is strictly applied.
Not for a planned multi-billion-dollar project.
Exactly. Critics say this isn't some minor adjustment. It's a planned undertaking that fundamentally changes how nuclear policy works. They argue that if the NRC grants this exemption, it essentially lets NextEra rewrite major nuclear policy through a side door, avoiding the normal, lengthy public process for creating new regulations.
Okay, that's a huge regulatory hurdle, potentially precedent-setting in a way that worries people. But let's say they clear that hurdle. There are still fundamental safety concerns about the type of reactor they're trying to bring back online, right?
That's the design risk, and it's serious. DAEC is a General Electric boiling water reactor, specifically a BWR4, and it uses what's called Mark I containment.
Mark I containment. Why does that ring a bell?
Because it's the exact same reactor type and containment design that was involved in the 2011 Fukushima Daiichi disaster in Japan.
Okay. Can you explain simply what the alleged flaw is with Mark I containment?
Well, the core issue critics raise is that the containment structure the building designed to hold in radiation and pressure if something goes wrong is just too small relative to the size and potential pressure buildup of the reactor inside.
Too small.
Yeah. In a severe accident, like a loss of coolant accident or LOCA, the pressure inside could build up so rapidly that the Mark I structure might not be strong enough to withstand it. The analogy sometimes used is it's like trying to contain a powerful explosion inside a vessel that was designed for much lower pressures.
And this isn't a new concern. People knew about this.
Oh, this dates back decades. Critics often point to a very public statement made way back in 1975 by two GE engineers who actually resigned over safety concerns related to this design.
Wow. What did they say?
They contended publicly that the Mark I design was, and I quote, so flawed it could lead to a devastating accident, precisely because of these containment limitations. Now, obviously, NextEra and the NRC argue that many operational procedures and regulatory requirements have changed since 1975 to mitigate these risks.
But restarting a plant with that known historical design concern, that's a significant risk they're taking on.
It's definitely a palpable risk, yes. The historical context adds weight.
And if the worst-case scenario did happen, despite all the safety upgrades and precautions, what's NextEra's financial liability? Is it unlimited?
No, it's not unlimited. Due to a U.S. federal law called the Price-Anderson Act, liability for nuclear incidents is actually capped and shared across the entire industry. For any single incident at any U.S. nuclear reactor, NextEra would be subject to what are called retrospective assessments. Basically, they'd have to pay into a pool. Their maximum exposure per incident is capped at $1,161 million.
So about $1.16 billion.
Right. And specifically for FPL, their share of that potential assessment is around $664 million per incident, which they'd have to pay over time. And while that caps the direct financial hit,
The reputational damage, the community impact.
would be immense.
Yeah.
Absolutely devastating. So even with the cap, it's a huge liability they carry as a major nuclear operator.
Okay, let's shift gears a bit from the nuclear-specific risks. Let's look inside the company. Are there any financial red flags or operational complexities investors should be aware of? I remember seeing something about an impairment charge earlier this year.
Yes, that's important context, especially when you see these massive spending plans. We need to talk about the $0.7 billion impairment charge they took in Q1 2025. That's $700 million pre-tax, about $500 million after tax.
$700 million is a big write-down, even for a company NextEra's size. What was that related to?
It was related to NextEra Energy Resources equity investment in a company called XPLR Infrastructure, LP.
Yeah.
Now, XPLR used to be known as NextEra Energy Partners, LP, or NEP. It was a spin-off designed to hold operating assets and pay distributions.
Okay, so a related entity. What happened to trigger such a huge write-down?
XPLR announced a major strategic shift, and the critical part of that shift was their decision to suspend cash distributions to their common unit holders indefinitely.
And for those kinds of partnership structures, the whole point is the distribution, right?
Pretty much. The core value proposition for investors in those LPs is getting that steady, reliable cash payout. When XPLR cut off the distributions entirely, it basically broke the investment thesis for its common units. The trading price plunged.
And NextEra, as a major owner, had to mark down the value of its investment on its own books.
Exactly. They had to write down the value of their stake from $1.7 billion down to $1.0 billion, resulting in that $700 million charge. It's a reminder that even a company as sophisticated and well-managed as NextEra can face significant complexity and, well, stumbles within its own corporate structures and financing vehicles.
Beyond that specific XPLR issue, are there other financial sensitivities? Things like market volatility?
Well, like many large energy companies, they use derivatives extensively, mostly for hedging. But derivatives come with their own risks, particularly around liquidity.
How so?
Many derivative contracts have what are called contingent features. These are clauses that could force NEE to suddenly post a lot more cash collateral if certain triggers are hit.
What kind of triggers and how much cash are we talking about?
Triggers could include things like a downgrade in their credit rating, or maybe failing to meet specific financial ratio covenants. If one of those triggers were hit, NextEra estimates they might need to post up to approximately $2.0 billion in additional collateral.
$2 billion suddenly needed as collateral. That sounds like a potential liquidity crunch.
It's a significant operational risk, yeah. Finding $2 billion in cash or eligible collateral quickly, especially if the trigger event happens during market stress, when liquidity in those over-the-counter derivative markets might be tight. It's something they have to manage carefully. It means they need to keep a substantial financial buffer, which is always a bit of a balancing act against their aggressive spending plans.
Okay, that sounds like a serious consideration. But let's balance the risk side now with NextEra's strengths, their competitive advantages, their moat. They're famous for being pretty well insulated from external shocks, right? How do they protect themselves from things like rising interest rates or supply chain chaos?
They have built some really robust moats, both financially and operationally. Let's start with interest rates, which is a huge concern for capital-intensive businesses. NextEra's financial hedging program is enormous. As of the end of Q3 2025, they had about $44.0 billion in notional value of interest rate contracts.
$44 billion in hedges. How much does that actually protect their bottom line?
A lot. They estimate that even if interest rates suddenly jump by 50 basis points, that's 0.5%, the impact on their adjusted EPS in 2026 would be maybe zero, maybe negative 2 cents per share at most.
Wow, so basically negligible impact from a half-point rate hike.
Pretty much negligible. That insulation is a massive competitive advantage. It means their multi-billion-dollar CapEx plans, their ability to offer competitive prices in those long-term PPAs, aren't likely to get derailed just because the macro interest rate environment changes. It provides huge certainty.
Okay, that covers financial insulation. What about the physical side? That giant 29.6 gigawatt backlog needs a lot of panels, turbines, batteries. How insulated is NEER from global supply chain disruptions or tariffs?
They've done a remarkable job securing their supply chain, too. NEER currently has locked down about 1.5 times the amount of equipment panels, turbines, etc., needed to actually build out their entire development pipeline through 2030.
1.5 times coverage, so they have way more than they need secured.
Yeah, they buy way ahead, and in huge volumes, which gives them negotiating power and buffers them against short-term disruptions. Plus, they're actively working to make sure their key suppliers meet the U.S. government standards for foreign entities of concern, EPOs.
Why is FEOC compliance important?
It minimizes their risk of getting hit by tariffs or other trade restrictions aimed at specific countries or companies. It basically de-risks their supply chain from geopolitical issues as much as possible.
And lastly, their actual development platform. It seems like that sheer capability is a moat in itself, especially now with regulators pushing for big customers like data centers to basically arrange their own power sources.
Absolutely.
Yeah.
You mentioned the Department of Energy guidance to FERC pushing this bring your own generation idea. NextEra is perfectly positioned for that. Why? Because they're really the only major player with deep expertise and a proven track record across every major generation technology.
Renewables, storage, gas, and now nuclear.
Exactly. They can build anything, anywhere, and tailor complex hybrid solutions that data centers increasingly need. You need reliable gas backup for your massive solar farm. They can do that. In fact, they've built more gas-fired power plants in the last 20 years than pretty much anyone else. They've got a pipeline of about 20 gigawatts of gas projects already developed that they can pull off the shelf if needed.
So that comprehensive toolkit makes them almost indispensable to these hyperscalers with massive, complex power needs.
It makes them the go-to partner, definitely. A huge competitive advantage. Hashtag tag V synthesis and final verdict.
Okay, so let's try to pull all this together. What does it all mean for someone listening, maybe thinking about NE? We've got the incredibly stable FPL engine, the huge growth pipeline at NEER, this really high stakes, maybe even risky nuclear bet with Google, but also these significant financial sensitivities. How do we synthesize the investment thesis here?
Well, I think the thesis really holds up. NEE operates as this masterfully constructed two-part entity. You have FPL, the low-risk, super-efficient, regulated utility. It provides that critical stability, access to cheap capital, steady, predictable growth from its own investment.
The foundation.
The foundation, exactly. And that foundation effectively underwrites or makes possible the other side. NEER, the high-growth, strategic, and yes, sometimes high-risk infrastructure developer, they're using arguably the most predictable cash flow stream in the entire industry to fund these aggressive, calculated bets in the highest growth, highest margin parts of the energy market today.
And the runway for this growth seems pretty long, right? Largely
Yes.
because federal policy is backing it up for quite a while.
Precisely. The policy tailwinds are huge. Think about the extension of federal tax credits under recent legislation. Solar and wind projects get support through 2030. And critically for NEER strategy, new energy storage and nuclear projects like that DAEC restart are eligible for credits all the way out to 2039.
2039, that's almost 2 decades of regulatory visibility for their biggest strategic bets.
It provides a very long, very profitable runway for development.
And that DAEC deal with Google, it really feels like a statement piece, doesn't it? It shows NextEra is willing to push boundaries, accept complexity and risk to capture that specific type of power reliable, 24/7 high margin that the AI hyperscalers absolutely need.
It really does. It's designed to ensure they keep delivering sustained high-quality growth well into the 2030s. You heard management say they feel very good about their project pipeline visibility for 28, 29, and 30. That confidence comes directly from seeing this accelerating demand and knowing they've positioned themselves aggressively, especially with this strategic nuclear move, to capture it.
Now, given that mixed stability, guaranteed returns from FPL, plus this aggressive, strategically positioned growth from NEER, it's maybe worth touching on valuation quickly. Where does it sit now?
Yeah, looking at the forward price-to-earnings ratio, the PE, it's currently sitting around 23.5 times earnings.
Okay, and how does that compare historically for NAE?
It's actually slightly below their recent 5-year average, which was closer to 25.2 times.
So maybe a suggestion of slight undervaluation, or at least not overvaluation, despite the strong outlook.
It could suggest the market isn't fully pricing in the scale and, maybe more importantly, the certainty of that long-term, high-quality growth trajectory NEE is building, especially if they pull off this DAEC restart. And it really does become the template for serving hyperscalers. You combine that sustained earnings growth potential, the premium 10% dividend growth target, and their unique strategic position. It likely points towards continued premium valuation, assuming they execute well.
Which brings us then to our final provocative thought for you, the listener. We've talked about the lack of precedent for restarting a mothballed U.S. nuclear plant. We've talked about the historical safety concerns, however mitigated, around that Mark A reactor design. So the key question maybe isn't just if NextEra can technically pull off this $9 billion project and get DAEC's 615 megawatts back online.
Although that's a big question in itself.
It is, but maybe the deeper, more fundamental question for the entire U.S. energy industry is this. Will the NRC's decision on that exemption request, whether they grant it or not, end up fundamentally resetting the rules for how long nuclear power plants can operate in the U.S.? Could this Iowa project accidentally open up a whole new pathway, a whole new economic model for using the existing nuclear fleet and maybe even building new advanced reactors to provide that essential carbon-free baseload power that the age of AI so desperately needs?
That's the multi-trillion-dollar question, isn't it? The implications of that one regulatory decision in Iowa could ripple out and reshape the economics, the viability, and the future role of nuclear power across the entire country for decades. It could really redefine how we power our high-tech future. Hashtag Tag 6 outro.
A really profound thought to end on, especially as we see this AI-driven energy demand just taking off. Well, thank you for joining us on this deep dive into NextEra Energy. We hope this pretty detailed exploration of their dual structure, their financials, that big nuclear gamble. We hope it helps you connect the dots and understand the complexities shaping America's energy future.
And remember, as always, critical thinking is key. There's a lot of information out there. We always encourage you to look at the underlying sources yourself, really understand the scale of these investments and the nature of the risks involved.
Absolutely. Thanks for tuning in, and join us next time for another deep dive. Risk defined, portfolio protected.